I'd like to thank all of you for joining us for the inaugural Trends in Asset Management Conference. It's been a fantastic 2 days filled with great discussion and valuable insights. We have one more event in our program, and I know it's one that we're all very much looking forward to. Joining us to discuss the latest trends in asset management are Perry Traquina and Dan Simkowitz. Perry is the retired chairman and CEO of Wellington Management Company. He currently serves as the director of Morgan Stanley, eBay, and Allstate. A graduate of Brandeis University and former chair of the Board of Trustees, Perry is also the chair of Brandeis International Business School's Asset Management Council. I want to thank Perry for all he has done to lead our council over the last 3 years that has led us to this conference. This conference was first scheduled for 2019, and we're very, very glad to be able to put it on now. Dan has worked at Morgan Stanley for 32 years. He is now the head of investment management in Morgan Stanley and the co-head of firm strategy and execution. We're very pleased and honored to have him join us today. Perry and Dan, thank you both for joining us. Perry, the floor is yours.
Thank you, Dean Grady, and welcome everybody to our last session of this inaugural Trends in Asset Management Conference. I'm joined today by Dan Simkowitz. Dan runs Morgan Stanley Investment Management, which at the end of 2021 had 1.6 trillion assets under management, one of the largest global asset manager firms globally. I've gotten to know Dan quite well over the past 7 years, ever since joining the Morgan Stanley board, and we've had many conversations over the course of that time on the industry. And so I'm hoping that this fireside chat will impart some of those discussions to you all today. And with that, Dan, welcome. Thank you for being here. And maybe we can kick this session off by asking you to relive a little bit of your Morgan Stanley career. How did you come to Morgan Stanley? 32 years at one firm is a long time, and maybe you can give us a quick catch up on how you came to Morgan Stanley, what's your career been like, and how did you come to lead MSIM?
Great. Well, thanks, Perry. It's an honor to do this with you, and Dean Grady, thanks for including me in the Brandeis team. It's a real honor to be part of the institution and today's event. Wow, Perry, 32 years, you had to remind me. What it does is you think back, the world's changed so much, but I came out of college having never taken an accounting class. I don't think I'd ever seen an annual report, even though my father was a business school professor, so I have a lot of allegiance to this type of program. It hadn't been imparted. And it goes also back to the quality and the excitement of the apprenticeship model. So I joined a firm called Alex Brown and Sons. At the time, it was, I think, the oldest securities firm. I joined their mergers and acquisitions group in Baltimore, Maryland, and I was involved in consumer M&A, otherwise known as pizza chains and convenience stores, and it was great. And I had an incredible mentor and first boss. And I think what he had was patience for someone with my background and just real great expertise. He had been trained in some of the big Wall Street firms. And I came out of that 2 years, though, wanting a little bit more. And so my view, and part of it is carried on for the last 32 years, a bit more markets oriented versus maybe just business oriented, but I'll get back to that in a second. More international. Alex Brown was very domestic at the time, and a little bit bluntly, could I play in the big leagues? A little bit of New York, and so I went to the Columbia Business School, and in between those 2 years at Columbia, I joined Morgan Stanley as a summer associate, and I've been here for 32 years. My father taught at a business school for about 36 years. We used to think he was crazy one place, and now I'm becoming my parents. But it's been fantastic. And I started off briefly doing M&A there, but quickly joined the equity capital markets group. Wellington, your former firm, was a huge partner of me and my team through many of those years. I was very fortunate. The firm is really global and really encouraging curiosity and mobility. And so I spent 3 years in Asia, relatively early in my career, both Tokyo and in Hong Kong. Came back, managed some of our transactions in the capital markets area, and then was given an industry group to focus on. The first industry group they gave me was energy, paper, chemicals. I said, did I do something wrong? And then later on, I got a little tech, but I got tech right as the 2000 tech bubble was crashing. And then I started getting responsibility around businesses. And that's a real change around what Morgan Stanley is today. Is it was a collection of craftspeople when I joined, and now it's a great business, and it's sort of delivering value to clients with a whole bunch of ways to do it. And ultimately led our global capital markets business, which does all the new issues and capital raising for all of our clients and the advice on capital structure. And then in 2015, I think, I had spent a fair amount of time with our CEO, James Gorman, first around the acquisition of Smith Barney and helping him and the team. But in 2015, he asked me to run investment management, and it's been an incredible run. I think James saw me as a business person. I mean, you may be even more privy to these conversations being on the board, but I had some experience. BlackRock was one of my big clients when they had done the acquisition of Merrill Lynch Investment Management, and also Barclays, the iShares business, and then also the private equity firms around that time of 10 or 15 years ago were all going public. So Blackstone, KKR, Carlyle, Ares, and so I knew them as a sort of strategic matter. And then James asked me to join MSIM with a growth mandate, which I often connect back to you and the board. And we've had it's really been a tremendous period of action and activity, and busy all the time.
Great. Thanks, Dan. We'll come back to your career a bit later, because I think you might have some lessons learned that you might want to impart to our audience today. But let's shift a little bit and talk about MSIM. As you mentioned, James Gorman has been quite clear, Morgan Stanley's CEO, about Morgan Stanley's strategy, namely one of shifting the business mix towards wealth management and asset management over the past 10 years. And I'm wondering, maybe you can talk a little bit about that strategy and how that has affected MSIM over the last several years.
Yeah, I think the sort of growth of investment management and wealth management as a proportion fits within I would say the overall corporate strategy, which James has really engaged with us on and delivered phenomenal results for the last decade. That strategy is pretty simple, and we think very powerful. We just help clients allocate capital and get market access and invest. And to a degree, that's all we do. We do it around the world. We do it in all three of the sort of publicly disclosed business segments: wealth management, investment management, sales and trading, investment banking. But it wasn't always the case. We own the Discover card, not really an investing platform. We used to, and it's all for clients. We used to do some stuff, proprietary trading. We owned shipping terminals for ourselves, not really client driven. But today, and really for the last decade, it's all about clients. It's all around helping them invest their capital and invest. And to a degree, we like all the parts of it. And our DNA is market-based, and our DNA is around advice. And that is core to what the securities business does. Securities business will help a company raise money, allocate capital. It'll help big asset managers, the startup hedge fund, venture capitalists, private equity firm, all invest and monetize capital. But those businesses do require capital. And so the other very complementary, almost same business is providing advice and investing into individual wealth management clients or investment management clients. And for the most part, that business doesn't require capital. And so, we just had a view that we can just do all of that really, really well. The securities business, sales and trading, investment banking, has grown market share, but the incremental, I would say, capital and talent resource over the last decade, even though we have been increasing share there, has skewed to wealth management and investment management. Started with the ultimate acquisition of Smith Barney right out of the financial crisis. And then really in the last 5 years, we've seen just great strategic, I guess, moves and incremental investments around wealth and investment management, such that, you know, now that's more than 50% of the revenue mix of Morgan Stanley. And the market has really appreciated that. You know, I was at a conference yesterday with our biggest wealth management advisors. If you go back and that to the first week of October of 2020, we closed the acquisition of E-Trade, again, an investing platform. And then we announced the acquisition of Eaton Vance, a wealth management-based investment management platform. So very much in that vein of strategic shift. And our stock is up 80% since then. And we've outperformed some big banks by, you know, 30%. We've outperformed big asset managers by like 70%. The firm that we've correlated the most to is Charles Schwab, which is a pure, no balance sheet, you know, sort of wealth management, investment management platform. So that's been the shift. And investment management is a pure sort of client-driven, fiduciary-driven version of that advice strategy that the firm holds. And we had a great brand, great sort of investing history dating back 40 years, but we needed to grow, and we had the capability to grow. And then, you know, through James and the board, the resources to go out and grow the investment management business quite significantly.
Yeah. So Dan, given that growth mandate, and I think it's fair to say that, as you pointed out, the industry, the asset management industry, has changed quite a bit in the last 10 years. There have been, you know, significant areas of growth, new areas of emerging asset growth. ESG would be one of them. There's been fee pressures. But given the growth mandate that you have for the business, what are, in your mind, the key trends affecting the industry today? And then I'd like to follow up on that as it relates to MSIM's strategy going forward.
Sure. I think you got to almost look back the last decade, maybe 15 years, because it's set, the trend there is continuing. So I think the technology coming into the industry, new players consolidating the industry has changed it. And the big disruptive change in this industry, and it'll continue to be, is that beta, market access, is free. So you can see it if you're an individual, you can go onto Schwab or E-Trade and trade for free. But probably as it relates to investment management, the big thing is that you can go get an ETF and get exposure to the S&P 500, or even slices of the S&P 500 or the Morgan Stanley World MSCI World Index, and get your exposure effectively for free. And that came about as two really important companies in the industry. Vanguard had that mentality, but they had always done it in mutual fund form. But they always wanted to be sort of cheap and free and evangelist on that. But BlackRock, as I mentioned, bought the iShares business. Great business people at BlackRock. They buy an iShares business. They now have that index capability, and they put it in an ETF, which is really just a wrapper or vehicle, but very efficient. And they start to compete with Vanguard, and the price of beta goes down and down. And what that means for the rest of the industry is the bar is higher, and the bar around active management and the alpha you can provide and the value you can provide is just dramatically higher, because that, you know, we're not operating off of a, you know, 25 basis points or 1/4% or whatever as your starting point. Also, technology and analytics can pull apart your returns with a click on the internet for free. And so in that world, you got to just prove your worth all the time. And that's the biggest driver in the industry. And so you need to figure out how you are going to add value away from that market access that's differentiated. And you can't do that just by an advertising campaign, because that's, they're firms like Morningstar that have developed to say, no, that's not enough. You got to deliver real sustainable value. And so then the trends that we are operating under to continue to deliver value, but do it in a competitive, efficient way, I would say are, you can't run a really diversified portfolio that sort of hugs the index and then try to charge a high fee, because BlackRock and Vanguard will spend all day picking on you. And so you gotta more and more run high conviction, concentrated strategies in equities or unique credit strategies in fixed income. And we were very fortunate, at least on the equity side, that our history was around high conviction equities or emerging markets, which are harder to replicate in that sort of free beta world. And we acquired, Eaton Vance, who was very value add fixed income. But the other big sort of thematic secular trends, customization. So not everybody wants to buy that commingled generic index fund. They want something customized to themselves. Right now, the big two trend lines around customization are taxes, because everybody's tax situation is different, especially at the state level and where they are in their retirement path. And then the second one is sustainability. Everybody's view on sustainability is different. And there's a lot of people saying, well, we want standards, but ultimately at the wealth management level, that's going to be a very personal decision, all of which fits into a trend around customization. The second one, linked sustainability. People want to think about, especially we're seeing big generational shifts and surveys, want to think about how their investments matter in the world. And that's out there. And then the third one is illiquidity is an asset class to a degree. Yeah. And if I can afford not to have to go grab my money every day or trade it every day, I might get paid for that. And oh, by the way, in doing so, I also may give the asset manager more flexibility to do things, and i.e. they can own the entire company, private equity, or they can do special things as long as they can hold on to the capital for a longer period of time. So illiquidity, which it translates to alternative investments, another big trend. Those are our sort of secular constants that we think are driving the industry: customization, sustainability, illiquidity / alternatives.
So with that, I think you've laid that out extremely well. With that, as you think about MSIM and its 1.6 trillion in assets, how do you drive the strategy for MSIM going forward? What are the key focal points, focal areas for MSIM? And maybe you can talk about parametric as being one of them, your efforts in sustainable investing as another one, and then the third one, the one that you just touched on, what is MSIM's approach to the private capital markets, private equity, venture?
Yeah, a few things. I would say two big platform themes, I would say, are that at our scale, and we've sort of given our history and where we are, we've become one of the scale players. So at our scale, you got to be global, in that you can't have a great either solution or investment team and only offer it to clients in a fraction of the world's population, because that portfolio manager or that idea, it might be applicable around the world, and if you're not taking it around the world, that IP or portfolio manager may go somewhere else to somewhere it could. So we are very, very lucky at Morgan Stanley to have an incredible global footprint to go, and to a degree, amortize our great investment and solution capability across clients. And it's not just all the clients at the same time, but what we see in the US, in one part of the cycle may be applicable to Japan 3 years down the road. And vice versa in its thing. So global is one. And then the second one is performance is required, like great performance, but it's not sufficient. There's got to be a service layer in between. So in places where we aren't seeing fee pressure, which there are a fair amount, the service level is going way up, meaning the client wants to know, yes, we're managing their real estate, but they want to know about their whole portfolio. And oh, by the way, we're not going to really pay you for all that advice that you're bringing to us on the whole portfolio, or how to do risk management, or what do you think about China, even though you're managing a U.S. mandate. But you got to do that to hold on to the original mandate. So that's one. As it relates to the big three secular trends, we're very fortunate in the acquisition. Well, not fortunate, it's why we did it. In the acquisition of Eaton Vance, a great business that embedded in that, as well as the value add fixed income business I mentioned, was Parametric. And Parametric is the leader in that customization trend that I mentioned. They've been around for 20 plus years. They've built an incredible tech-enabled platform to help wealth management advisors help their clients customize portfolios, again, largely around taxes and sustainability, but it could be risk, but it's really around those two very personal elements. And we just continue to invest in making that process more efficient. As we make it more efficient, more people can use it, because it's quite a sophisticated service, and then more, I guess, features. And so, for example, we used to do it off the S&P 500 or things like that, but our most recent feature set is a tax customized portfolio that matches the investment guidelines of the Morgan Stanley Wealth Management CIO. So you can combine it in many ways. So that's really exciting from a customization perspective. And we're in earliest innings still. If you look at the trajectory path of ETFs, customization is following that curve, but we're in the very beginning of that process. Sustainability probably was faster, harder in Europe. We've had some success on the Morgan Stanley side, but it's coming in the United States, really around, as I mentioned, a little bit around generational change and what our kids, my kids, want to do with their capital as they achieve it. And my daughter started working, and she cares about this stuff, her 401k and other elements. And also, probably climate change being sort of an overriding sort of issue around investing. And so again, we're very fortunate that in the Eaton Vance transaction, Calvert Funds, the original sustainability investing firm, was part of that. Calvert came out of relevant for an educational institution, the divestment movement around apartheid. And so they've been doing sustainability before anybody even knew what ESG was. And so they got great research framework. And so we're taking that brand and that research capability, and back to my earlier global comment, Calvert was operating extremely well in the US, which is actually not the big sustainable market. Europe is. We take Calvert now around the world. And then on the private side, I would almost argue it's at the entirety of Morgan Stanley. Here is a place where all parts of the firm can deliver huge value to the ecosystem. So in my old group, M&A, let's say capital markets, we can help a private equity firm buy something, both in the advice and the financing of that, and then on the exit of that, when they sell it or take it public, as an example. But also in investment management and in wealth management, we're really engaged with private equity firms. We help, just in investment management, we co-invest with other private equity firms. We have a fund that takes some of their best assets and lets them hold on to them for a long time. So partner there. We're a big provider of loans into private credit firms in the asset management division, because banks want to do less of that. And so all around participating in that ecosystem. And when I say private equity, I sort of also mean private real estate or infrastructure. And then we do a bunch of that within investment management directly. What we're trying to do in MSIM is play on the strengths and sort of relative value of the Morgan Stanley brand and capabilities. So we're not a large cap private equity manager like a Blackstone or KKR, these great firms I mentioned earlier. But what we're trying to do is take the power of the Morgan Stanley brand, our global network, our analytics, to the middle market of M&A, because there we think we may have an unfair advantage in delivering alpha to those companies versus a firm that's only in the US and doesn't have the same resources, because we're not competing in that deal set with KKR and Blackstone, who are obviously large, or special ideas. We have a group that does complex transactions, and they use the engine and the sourcing of the whole Morgan Stanley network around things that are complex or need confidentiality or speed. So we're always trying to, the phrase we've used for 5 or 6 years throughout the whole business is differentiated value.
Mhm.
Where can we bring differentiated value to the client? And if we can't, let some other great firm do that. You know, BlackRock doing that commingled big cap beta, or Blackstone doing large cap private equity, just to pick 2 names that sound alike.
Yeah. Dan, you're highlighting that, and I think it's fair to say the industry X market really isn't showing much growth, but you're highlighting that there are these growth vectors within the industry, whether that's sustainability, whether that's customization, tax efficient accounts, private capital markets. Those are all key vectors for the growth. The industry is probably not growing that much. I'm just wondering, maybe you can give everybody an update on, you guys are growing. How quickly are you growing? How sustainable is that?
Yeah, I would say the industry will probably grow AUM as you know, as just the economy of the world grows and you get more economies moving into middle class, the AUM will grow. What won't, and it'll grow, you know, in and around GDP. What won't necessarily be growing, and actually could be growing less than that, is the revenue pool.
Correct.
As it relates to the public markets, because the proportion of that incremental AUM as well as replacement of existing AUM is going to go back into those index funds and that free beta I mentioned. So if the AUM's there, but it's being charged free because it's allocated to beta, that'll go down. So back to our, you know, you got to find these places where there's going to be incremental secular growth and where you can participate incrementally because you're delivering differentiated value. And so, you know, where we 5 years ago, and I'll use revenue actually, since I just said it's the right term, you know, we were about a $2 billion asset manager in revenue terms. And then prior to our acquisition of Eaton Vance, we'd grown to $4.5 billion. And then they had $2 billion and they're 6.5, and they were growing pretty well along the way, delivering on the strategy. The growth there is around having equity strategies that were not really diversified, trying to charge a high active fee. So we were very concentrated in our conviction there. Alternatives, as an example, and then being global. You know, being where that GDP growth, that move in assets is going to be greater than the economics. And there's a number of places around the world where even the economy may be big, but the AUM or the revenue growth potential, because they're early in their move to risk or equities, it will be even greater. And then clearly, if the alternatives allocation goes up in portfolios, that's a higher value add, a little bit riskier, higher barrier to entry market. And we were able to, the fair value for that is a higher fee rate than the lowest of them, which is the free beta I mentioned.
Yeah, yeah. Within the context of the MSIM strategy, obviously you've been an acquirer, so there's opportunities for organic growth, which you're demonstrating vis-a-vis some of the vectors that we've already talked about. Also inorganic growth, Eaton Vance obviously being a huge acquisition for Morgan Stanley and for MSIM. The industry historically hasn't been that successful with M&A. It's hard to put cultures together. It's hard to keep talent. What are some of the lessons learned thus far with the Eaton Vance acquisition? And maybe you can talk a little bit about how do you foresee the industry evolving with respect to concentration and M&A? Is it going to change from what we've seen historically? Do you think this is a new era where there will be much greater consolidation?
So I think if I take a step back, how we think about it, we're the whole, I guess, strategy element is listening to the client, right? Or sort of evaluating the client. We're very fortunate I mentioned that geographic breadth that we had, but we also have, whether it's institutions or wealth management in any of those regions around the country, we have dialogue. And so, again, what we're always trying to test is, are there places we are not where our clients want us to be because they've experienced the value we can bring, and we both are seeing the market and saying, well, if you're right over there at that adjacency that you're not in, we would like that. And if the clients are telling you to go that way because they want a new provider, or it's a new space and they trust you to be their partner, that's been a big driver of our sort of incremental growth capabilities. The other element of the growth is we're not out looking actively to acquire, let's say, concentrated equity teams. Part of the reason is it's tough business. Alpha, you were in it for a long time.
Yep.
The other element is we think we can train and nurture next generation talent. And those are people we know the best. They know how to operate. We get to be really patient in their development. And so some of our growth, as an example, very organic, like not just hiring a couple of people, which I'll mention in a second, was a gentleman who had been trained here in New York. He goes to Asia for personal reasons. We seed him with a little bit of capital, the team and Morgan Stanley, and he runs a global firm out of Asia. He's an American, and he was the fastest growing asset manager in the team in the last 5 years. And so that was a way of nurturing talent, putting in a right spot and going, and then using the Morgan Stanley network to help him raise capital off his extremely phenomenal performance for the last 10 years. And what's interesting about his fund today, his flagship, a third of the assets are in Asia. The third of the assets of his clients' assets are in Asia, Europe, and the US. And actually, he's probably got a portfolio that also is global by nature. So no fund in the entire world is as synchronized between where the clients come from and where the assets are invested. The other element is we see these places largely in the alternative space where we're like, we could be good at that. And then we run a pretty agnostic, hopefully level-headed buy versus build conversation. And we're getting a lot of notoriety around Eaton Vance and an acquisition before that, Mesa West. But in our alternatives, a lot of it has been where we go out and hire a person. Usually it's a person, and then they go build a team. And then they go build a team. And we say, you got a couple of years, but we have a lot of confidence. We can partner with our best institutional clients or wealth management to help you get some capital on the ground. And the view is after 5 years, hopefully we have a winner. And we've had a whole bunch of those where the right choice, as long as we could be patient around culture and it was and just economics, was to build. And we did that on private credit in the United States. We did it in the special situations fund I mentioned. I'll give you another just example of that. We ran the largest core real estate fund in the United States. And we run purposefully, we run a very global, successful, opportunistic real estate. So risky real estate we run globally, and less risky real estate we ran regionally, only in the United States. We had clients who were investors in both, and they said, well, we understand the strategy. Can you now do core real estate, the less risky, in Europe? Right. Because we know you've got a European team that's really good because they're doing the risky investing. And we know you know how to do core real estate, the less risky in the United States. Let's do core. And they give us the capital. We hire the talent. We did that in both Europe and Asia. So that's an extension strategy, which we find very exciting. And then M&A. But I think the bar is really high. And this is not just a Morgan Stanley comment. I think the bar should be really high for the industry, because if you have investment capability overlap, I think these transactions are extraordinarily difficult. Right. And so I think that's where the industry has maybe underestimated the challenges. Because I think any M&A transaction, any combination, even a new hire, has frictions to it. And so we were very fortunate in both Mesa West, which is the small alternative manager we bought that did real estate debt. We were really good at real estate equity. We had never done real estate debt. But what we did is the principals knew our team really well, and they trusted them. So pretty low risk exercise. And in Eaton Vance, the overlap on the investment teams was just really low. So we were about to start to try to do what Parametric did, but we were 1/1000th their size. We really hadn't even started. In fixed income, in municipal bonds, bank loans, these are the premier Eaton Vance fixed income franchises, high yield. We were either small, just starting, or non-existent. And we had equity teams, but we in MSIM run our equity teams quite distinct from each other. They're like very separate alpha engines, self-contained research and portfolio management teams, and we had about 4 of those at MSIM. Well, Eaton Vance had one in Atlanta Capital, but in essence, that's not a merger. That's just adding a 5th thing. And so, what I would say is, we're dealing with a lot of work just on non-investment team overlap, and not even sales overlap. Just things like, for example, we've got a system around compliance, or we've got a system around travel and entertainment and expenses, or security, cybersecurity, or even building security. So all of those employees at Eaton Vance have to get used to a new benefit system. They got to figure out how to get in the building, same building, but different way to get in, how to fill out the expenses. All of that is an immense amount of work. Thank goodness we don't have to also operate in a world where our investment capabilities or even our sales capabilities overlap. One of the good things about Eaton Vance is they were really a wealth management US oriented firm. And MSIM was more than 50% international and skewed institutional. So not having those investment teams and sales overlap, really important, because we got a lot of other like day-to-day grinded out stuff that's hard work. Will take years. We learned that from Smith Barney. People's it wasn't around 2 advisors fighting it out. It was around the technology system that had to be merged. And so those lessons have played out. I think people will continue to try to buy alternative managers that they don't have, but prices are high because everybody wants the same stuff. And these are typically entrepreneurs, pretty strong-willed leaders of these independent alternatives firms. And so it's not always easy to find the right place and do the right deal. And if you do, it might be really expensive. And then these big overlapping long only mergers, I think, are going to be few and far between. If Eaton Vance didn't have very distinct things that didn't overlap with us, we would not have been interested.
So Dan, do you think that's the paradigm for you going forward, is that you will have, I would call them boutiques almost, investment boutiques operating under the Morgan Stanley umbrella, leveraging IT, compliance, a whole infrastructure, if you will, leveraging that scale, but in effect allowing these entrepreneurs and these boutiques to operate under the confines and distribution of a Morgan Stanley?
I think it's a bit more nuanced and one firm than that. And it depends on where we're at. So in equities, we run very distinct alpha engines, but they come up into a common operating platform and a common client platform that extends across the entirety of the thing. In fixed income, we run one MSIM fixed income business. Now we'll go to market with different brands. We'll go to market with the brand of Eaton Vance in the United States and Morgan Stanley in Europe. And then clearly the loan team is quite distinct from the muni team, but it's one organizational structure, which is distinct from the way we run equities. And the one thing I would say I learned about coming out into this business 6 years ago is strategy has to be very customized and individualized to the organization. And so you got to deal with the history and the capability set and the client relationships you have that are unique to your own. You see big market dynamics, which we've talked about in the first half, but the execution of all that has to be quite customized in the marketplace. And then, then we'll have, businesses like a Parametric is a business, but fully integrated into the Morgan Stanley and MSIM franchise, especially around some technology, but also unique linkages into our wealth management business. So I'd say one firm, but especially around equities, this is sort of back to our culture a bit, and it was certainly applicable to the way Atlanta Capital worked within Eaton Vance, is you give these equity guys tools, but give them space and tools, and then we supply sort of an infrastructure layer, and then we go tell the story. And that's probably going to be our way of doing equities for a while, as far as I can see. Whereas in fixed income is much more, and increasingly so, a solution. Clients need help. They need help to deal with inflation. They need to help against their obligations, depending on what type of client they are. They need a holistic solution. And we're very fortunate now at Evans to have all the pieces to go provide that solution, but you want that coordinated. Whereas equity is still alpha. And we're running really concentrated alpha that surrounds typically a beta core, and it doesn't need to be as coordinated. In fact, some of our equity guys compete.
Sure. Before we move off of the industry and MSIM, I thought I would ask a little bit about distribution, because when I was in the industry, there was always this sort of debate about whether it's content, i.e. the alpha generators, or whether it was distribution that it carried more value. Now you have product, MSIM, and you also have one of the world's largest wealth management firms with several trillion in client assets. How do you view those linkages between what you're doing and what the wealth management group is doing, and how are those ties? I know there are some compliance and regulatory issues that you have to contend with, but is that a strength? Or how do you sort of envision the tie between MSIM and wealth management?
First of all, I would say at that struggle between distribution, as I said, you sort of need great performance or you need a great solution. That's required. Now you need, and sometimes service is a solution, but you need a whole service layer, as I mentioned, and then you need to show up. And you need to show up, as I mentioned, globally with the right connectivity. That is really important in the market. So I don't think there's one, you can do one without the other. Certainly you need that performance, but if it's performance in someone's garage and no one knows about it, then it doesn't work. What I would say as it relates to wealth management, we used to not have, our relationship with Morgan Stanley Wealth Management was zero. We sort of got caught in a world where we were only focusing on institutions. This is 5 or 10 years ago. And even before Eaton Vance, we started to invest a lot in all of US wealth management. We did well in European wealth, and we did well in some Asian markets, but in the US, we sort of had retreated. So we invested a lot around just the resources that talk to all of the wealth management platforms. Obviously the ones that are growing right now are our own Morgan Stanley Wealth Management, but also the RIA network. I would say there is some distinction between alpha and solutions. The alpha is very open architecture. You can't try to convince someone to buy something just because back to just because someone took an advisor to play golf, or they saw an advertisement on TV, or they happen to be owned by the same company. That is pretty much long gone. You got to win alpha on the merits across the board. What I would say is on alternatives, as we think about new ideas, we have a very sort of three-way partnership in the firm between our securities business, who sees the markets, our wealth management, who has client sort of sensibilities around what clients want, and then ourselves. And we put that in an R&D lab, and we come up with new ideas. That is unique. Who else can do that in the world, actually? So that's great on alternatives. But on public equities, you got to live by your performance. What I would say is that the solution level, though, Parametric, which is not, it's not alpha, right? They're trying to provide a in essence, a service and a solution, then you can have pretty good partnerships. And part of the uniqueness of that transaction is we needed to deliver that to wealth management at Morgan Stanley, but also at other private banks and other wirehouses, and we weren't. And so, that connectivity around R&D and alts and solutions is quite good. And what I would say on the alpha side is people then say, wow, they're okay. Even though they work in the same firm, and I'm worried about the perception that I'm favoring the home team, well, the home team's really good. And the better we deliver performance and deliver service, deliver solutions, the whole thing works well.
Yeah. Yeah, let's shift gears a little bit. And I know we're starting to get in on the end of our session, but I like to shift gears a little bit because we have in attendance today some graduate students and people who are earlier in their careers, some Brandeis alums who are thinking about their careers. And I'm just wondering, do you think asset management remains an attractive industry for people to go into? And then secondly, what advice, if any, would you give folks as they think about their careers?
So I'll broaden it just a bit, but if you think about our strategy, we help clients allocate capital. Sometimes we do it really direct, like we do in investment management or a various form. That world, the markets world, the advice world, advice either, again, being an investor or being an investment banker or being a wealth management advisor, it's still a really fascinating world. Every morning you wake up and you see what's gone on over the night, and you got to think about, how do I translate that to my client base? Or you're working through the operations of, I just was on a call with our head of wealth management, Andy Saperstein. What is DeFi going to mean to the industry? And it's not going to change the industry anytime in the next 5 years, but somewhere between years 5 and 15, there could be massive changes. So then I'm going to go sit down and figure out what will exchanges look like? Will I be able to own a private equity interest in a part of a building because of tokenization? So every day you can wake up and learn and test yourself around the world and this industry. And again, it can range from all parts of Morgan Stanley, the industry of giving people advice on how to allocate their capital, including in investment management, actually doing it, is incredibly dynamic. And it doesn't change so quickly. So actually, you're probably not in danger of being disrupted overnight, but there are enough cool things, like I mentioned, disruption in asset management around free beta, or disruption around trading, around decentralized finance or other parts of it. There's enough cool long-term trends to also evaluate. So I'm still a big fan of learning the markets and jobs that test you to learn every day.
Yep. Any lessons or advice to those, now that you reflect back on your long tenured career, what pieces of advice would you give someone coming into the business today?
Curiosity is just key. That you want to be ready to learn. I would say flexibility, because there's going to be changes. So that flexibility can be, oh, I really want to be an investment banker. Well, maybe you should go to research, and then research can take you back this way, or it could take you to investment management. I'm a big believer in culture. I've been at Morgan Stanley 32 years. It's been a lot about the people. And so what is the firm, how does it feel? Are they a culture that likes to learn and is good at teaching? As an example. But the curiosity is probably at the top of my list. You got to want to engage and learn and be flexible. Some element of flexibility may be patience, but you don't want to be too patient. But you got to have that nice mix.
And in a similar vein, I thought I would ask you about, being a leader. You are a highly skilled executive. You work at one of the leading global finance organizations on the planet. You've obviously risen through the ranks at Morgan Stanley. What have you learned about leadership? What does it take to be a good leader? And again, we have in our audience today folks who are managing people. We have folks who are earlier in their career as executives, marshaling teams. Give us some of your thoughts on what does it take to be a good leader?
So I think there's some just things you gotta be masters of. I think you got to be a great listener, and maybe correlated to listening is be empathetic. I think linked to listening is also my comment around learning and teaching. The teaching is really important, mentorship, but learning is really important, because if you're willing to learn, then you'll change, and if you're willing to learn, you'll take biases down. So you got to be aware of the bias you bring into the situation. You got to have a good memory of your failures, right?
Yeah.
And you got to be willing to fail. I would say, as it relates to really growing as a manager and a leader in the second half of my career, hiring and surrounding me with people who are a lot smarter and better than I am, because then the leverage effect is just extraordinary. If you surround yourselves with great people around you, then the whole organization will do better, but you will also be able to gravitate to your highest and best use, because you're covered. And then the second thing is, if you got great people and you have a lot of confidence in them, they can also fail. So if you let them fail, you give them room by definition, and not that you want them to fail, but you give them enough plays where they will fail by just statistical, and then you give them because you believe in them and they're so good, they're so much better than you give them the backup and the encouragement to get up, learn, and then go move on. But that's hard to do if you're like, did they fail because they're not good? No, they failed because you gave them a lot, and that's just life. And that's enabling, if you can do that around that concept, around leadership, and just being clear-eyed, right? Try to take out favoritism, take out bias. Don't get stuck. I don't know, thinking out of the box sounds so cliche, but don't get stuck in all your old ways and hubris and all the rest.
Yeah. And we're almost at the end of our time. I have a few questions from our audience. I guess first, let me just start off by asking, given that markets are in flux and the Fed may be not our friend going forward, any thoughts on sort of where we stand today with equity markets over the next 6 to 12 months?
Well, typically we're thinking a bit longer than 6 to 12 months. But I guess our view is the next 5 years, even 10 years, is going to be a lot harder than the last 5 or 10. We had a liquidity regime that was pretty extraordinary, and now that is going to shift, and then people are going to have to adapt investing and markets for that. We have a legend in our group, Michael Mauboussin, who has written a lot of books around organizational elements of investment management and financial companies. And we got to get focused on investing in businesses, right? You got to make sure you're getting great businesses, and then some element of patience. But right now the forces around higher rates and higher inflation are like pretty dramatic. A lot of the practitioners in the asset management industry haven't seen these type of they've seen crisis moments, but they haven't seen this big macro economic shift, and so we got to go grind through all of that. But to a degree, I would say take the long-term view. The long-term view is own great businesses, do it with great managers when you can't do it yourself. If you can afford to, really evaluate where you can get some illiquidity, you get some great returns by giving capital to people who have more time to work with it and in different ways. Those are the things that we're focused on, and stay global too. I mean, I think there's a sort of deglobalization trend, but even if globalization isn't happening, investing outside of your home market may be really important. And there's countries right now like Germany who barely invest outside of the banks, their own bank accounts, let alone in equities in Japan. They're going to have to broaden their horizon just to pay for their retirements and all the rest. And those lessons still hold true here in the United States as well.
And a couple more. Is MSIM hiring? And if so, where do I find job opportunities?
We are hiring.
Yeah.
I'm going to stay on message though,
Yeah.
because what I would say is the markets are not easy. Back to your point, we got to be sensitive to that. But where are we hiring? We're hiring in customization, we're hiring in sustainability, and we're hiring in alternatives.
Yeah.
And so parametric is facing extraordinary demand. And so if you have any kind of technological background or interest level, entry level, a couple of years out, we're trying to match that demand and then automate processes. And so we're big demand. Calvert is hiring, the sustainability research and engagement area. And then, very at a much smaller scale, but definitely team by team that are growing. We're out looking for alternative teams. Those are typically experienced people rather than startups. So we're definitely hiring.
All right. Two more for you. Is Morgan Stanley exploring the use of smart contracts and blockchain technology for distribution or other processes?
The answer is yes. I spent an hour and a half today on that. It's not here today, but we've got to keep an eye on, and there's a lot of laws, a lot of rules, and a lot of friction to work through. But you can see a scenario where all kinds of assets can get tokenized. And by the way, they can be tokenized and not necessarily denominated in some digital currency. They can denominate in dollars, right? But the example I like thinking about is I look out this window and there's a building, and XYZ asset manager could own the building, but they, instead of having it sit in a private equity fund where they own the building, they're going to sell room by room cash flow out to all of you in some tokenized digital blockchain enabled technology, and they'll be able to do it really efficiently. That dream is not crazy. And so we are focused on it.
And the last one relates to compliance. How does the asset management industry actively manage the growing challenges of achieving and demonstrating regulatory compliance?
You just got to have processes, right? So, if you have processes and the employee base knows what those guidelines and rules are, then you work. But what I would say is the process-driven business of compliance. Yes, maybe some of the requirements are going up, but I would say over the next 5 years, and we've already started seeing the technology that you can use to match up against those. I think we're going to win the cost-benefit play in compliance, portfolio surveillance, some elements of risk management, because the cloud and AI will allow us just to do more with a lot more efficiently and take some of that human layer, which is slower and sometimes less accurate, and create a much more robust compliance routine. Because we need to spend a lot of what we spend on compliance is not bad acting, it's just mistakes, manual mistakes, or there's errors between a custodian and all the rest. If we can, back to the blockchain question, if we can come up with systems that are more automated front to back, more learn, like machine learning and AI, then a lot of this stuff could get rationalized and thinned down. And to a degree, then our organization, we can take some of that and apply it to, let's say, bad acting compliance, which we never want, or new products, or go talk to a client around something that's a little bit more high value add than the mistake on their trade.
Sure.
Right. And so there's hope around technology making all of this a lot more efficient.
Dan, I want to thank you for this. It's always great catching up with you on the asset management industry, and thanks for your support of the Brandeis International Business School. And with that, I'm going to turn things back over to Dean Grady.
Thanks,
Thank you,
Perry.
Dan.
Thank you.
Thank you, Perry and Dan. The discussion was great. Dan, your comments really reflected that you not only spent 30 years in the industry, but 30 years thinking really deeply about what you do. I'd like to say maybe even over 40 years, as your dad was a finance professor, and I can even imagine the conversations around the dinner table. It is also very clear why you are in the position to be not only head of investment management, but also co-head of strategy and execution. Your thinking is clear and incisive, and it's obvious you can execute on allocating capital, getting market access, and directing investment. So thank you for sharing your thoughts today. It was great. So this concludes the programming for Brandeis International Business School's inaugural Trends in Asset Management Conference. Recordings of this session will be available soon. If you would like to remain in touch with us or become more involved with our asset management programming, please email assetmanagement@brandeis.edu. Our thanks go out to our virtual audience, to all of the moderators and panelists, and to our event co-sponsors, the International Business School's Asset Management Council and the Rosenberg Institute of Global Finance. We appreciate your interest and hope you will join us again soon for a future event. Thanks, and have a great afternoon, evening, or morning, wherever you have joined us in the world. Thank you.